Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for July 28th, 2013. We have a market that remains bullish, quiet, and we're at overbought territory here on an annual basis, looking at weekly RSI 14 with a score of 72 out of 100. On a 10-day basis, we are at the upper end of neutral with a score of 73 out of 100 on the 10-day NDX. Looking at the market mosaic, price relative to the 200-day moving average is plus 11.24%, which makes it green bullish. We're among the strongest readings in the last 6 months. The 5-day slope of the 50-day moving average decayed a little bit to yellow neutral with a value of 0.31%. ADX remains around 20 with a reading of 19.9, so no trend. Relative volatility has continued to decline. It's now at 0.72%, back firmly into quiet mode. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average. It has a value of 1.17. Because that's greater than 1, that puts us into risk-on territory, or it favors exposure to riskier assets. When you look back 5,000 days, the Z-score value of that reading of 1.17 brings it to almost 2 full standard deviations above the 5,000-day average. This is a time series of that value. You can see right now it's just about 2 standard deviations above average, and you can see how quickly the truth changes and then how smoothly that cycling of volatility actually turns out to be, which is why we like that indicator. It gives us insights into swing trading for volatility directly and as a additional indicator of market condition in the short term. In the blended monthly rebalancing, no change to the 32 or the 13 ETF portfolios. They are still holding what they held from the start of the month. The next reevaluation is due on or about 1 August. In ETF2, the theoretical exposure of the model is at 70%, while the model portfolio itself still is at 80%, and we're updating stops this week. A number of very good case studies were posted in the chat, or from the chat room, were posted on the YouTube channel, as noted there. Taking a look at the blended monthly rebalancing holdings, you can see it's still dominated by the U.S. and the riskier assets. Small caps, then mid caps, then tech, then the large caps, and the conservative large caps in the U.S. are in the top 5. And the bottom still being occupied by Latin America, Treasuries, Australia. In the 32 ETF portfolio, financials, consumer discretionary, and healthcare and industrials join the small caps at the top of the stack. Brazil, gold, long treasuries, Australia at the bottom, along with Latin America. You still see about 50-50 split between those regional indexes that are on a buy signal versus those that are on a cash signal. And now you can see the real difference in choices that there are by getting the sector and market condition call right. You get the ability to have these numbers in your favor. Looking next at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held in the past and continue to hold in the future. We have a swing high right up here at about 170, and I'd like to see price close above that to form the next leg up if this continuation of this move off the bottom from 157. From 157. The river is the shaded blue area in the center, with the red line being the Bollinger Band mean. That's a 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain, or plus or minus 2 on that 30-period Bollinger Band. Thick black line is the 30-period regression line, lagged by 1 day. And the outer black lines are the channel, the normal channel formed by the maximum excursion from the regression line during the look-back period. This oscillating black line is the slope function of that 30-period regression line. You can see now the last 30 days have been almost as positive up as at any time in the last 6 months. We crossed the zero line back here when the market was around 165, and it's been getting nothing but better since that time. A cautionary note from the percent price oscillator: you can see the jaws have closed based on the relatively sideways travel over the last 10 days. That has caused the upward momentum to decay somewhat and close the jaws. The last time it did that, if we look at this as the nearest neighbor approach, we had this kind of a pullback. And so is that possible now? Yes, it certainly could. The tripwires are at 167 and 163 and a half. If it fails below there, then the potential for coming down to 160 and 159 is certainly there. But overall, 2 days where failure to fail further was the order of the day. Of course, it also did that in this section here, and that didn't slow it from failing further. But we want to be opportunistic if we see a runaway downside market, because you can notice that especially in this kind of a quiet bull, these one-day sharp reversals tend to be very tall red candles filled with real body, and so that gives you a real directional play on the other side of the trade that's suitable for frog trading or regression line crossover lens. So we'll be prepared for that eventuality. Looking at the ETF2 regional report, 7 out of 10 of the indices are on buy positions, or buy signals, so that's why we're at 70 and 30. Same as last week, no change. The S&P is still stronger than the globals. The U.S. indices, it's small caps, mid caps, large caps, tech, and then small caps and mid caps being the strongest of the 10 regions, and then the 2 weakest being Latin America and EPP coming in at 40 on the strength reading. Among the sector spiders, a number of them are doing better than the S&P, such as financials, healthcare, consumer discretionary, and industrials are moving along pretty smartly too. So all of those look pretty good. I like the reemergence of healthcare here. It's the second highest value out of that stack, and it's green on strength and white on consistency, meaning that it's recovering its top flight position, and money's flowing into it at a rate faster than it has over the last 10 weeks, which is why the strength is green but consistency is white. So that looks favorable for healthcare going forward. World market model. The U.S. is all above average. All of the small caps is exceptionally so. China remains strong. Everything else in Asia lagging except for Malaysia and Taiwan. Latin America and Brazil suffering in the Western Hemisphere. Only Canada is above average. Inside the alternate asset classes, private equity and oil are doing pretty well, although oil started to cool off a little bit. Gold, silver, and treasuries still continue to lag, along with real estate and bonds. Everything Europe is above average, except Austria and Spain continue to lag. Inside the business sectors, everything in the U.S. is doing better, in some cases dramatically so, like finance at 64 versus global finance at 55. So everything in the U.S. is doing at least as well or tied with, or excuse me, they're at least tied or better than the global counterpart, with strength in finance, healthcare, and discretion. Looking at the top 30 of the ETFs, little change from last week. It's still the alternate energy, biotech, banks, bio and pharmaceuticals, all the way down the stack, and then you can see the strength in the small caps and then some real estate, or realtors, excuse me. So no change in the week-over-week leadership. I like looking for those that are green under strength and white under the consistency column. That's the sign of new money. It still is the small caps, or money's being added to them. And financials are coming along, and here's a return to strength in healthcare, VHT. Looking at the Dow 30, Hewlett-Packard remains in the top of the stack. Even the worst performers in the Dow are at least out of the red, and these numbers come from their position relative to those 1,500 other ETFs. So there's a broad basis of comparison saying that strength in the Dow represents right now strength in the world. United Tech is making a nice move up. The recovery of financials this week, JP Morgan, Bank of America, American Express, all of those are starting to resurge. Coca-Cola still looks like a value play to me. Alcoa and Caterpillar continue to hold the bottom of the stack. Just some reference charts from about ETF liquidity. And now we'll shift over to the daily report. A handful of channeling and overreaction system signals and some setups available from the 551W strategy and real estate, mid-caps, industrials, Cisco, Home Depot, Alcoa, and Procter & Gamble. Microsoft continues to be an overreaction kind of a play based on their sharp losses in the equity markets. And the auto framer, these are all symbols that have tested out better than 2-to-1 using a mechanical approach based on trade location. A short signal in EPP. I'm reluctant to take that one automatically just because of the strength that we've seen in the world market model. However, if we see weakness in the U.S. and I see a chance to get on that intraday, I certainly will. You can see here how the volatility has cycled, plus or minus 1 standard deviation, then up to 2, and now back more than 1 standard deviation below the 6-month average, so very quiet. Dow Tactical Summary. Caterpillar and Home Depot and JP Morgan are 10 or under on the RSI2 value, a possibility of them being oversold or washed out. You can see Microsoft and Caterpillar offer kind of an extraordinary 9.2-to-1 and 8.4-to-1 on the auto framer. Caterpillar combines that with an RSI2 value of 2, and the fact that it wasn't an exceptional loser on Friday suggests to me that maybe that failure to fail further is an indicator that it may have found short-term local support and may be ready to attract value players like me one day at a time. Taking a look at the ETFs, a couple dojis, a couple channeling, and an overreaction signal in Japan. 551Ws in U.S. real estate, mid-caps, and industrials. The RSI2 value of less than 10 for Japan, agriculture, and mixed commodities. And some, I like the opportunities in 551W as well. Only a handful test out better than 2-to-1 on the reward to risk ratio. Here's auto framer for your reference stats if you're looking to set up. These would all be high priority trade frames for me to look at. I especially like Microsoft. Some market mosaic, some additional looks. This rebound from oversold conditions seems to have stabilized, has brought the power function back here to the regression line, so it looks fairly valued to me. Right here, I see the market at a natural hesitation point here with the slope of the 30 period regression line getting as steep as it has been in the last 6 months. I'm concerned that at least it hasn't failed further. There may be a chance to get another leg up here, but it's going to have to start marching north in order to maintain that slope. Failure to do so will sort of negate this recovery and then get us into a sideways choppy market. We're already near the 6-month high in terms of price with respect to the 200-day moving average. And that's why I'm cautiously optimistic here, but I'm also aware of just how sharply this thing can sell off and get back down below 160. Reference data on the fail stat for intraday traders and the signal to noise ratio. Excuse me. And that's everything that I want to cover, with the exception of this last chart here. We'll take a look at the z-scores of the regression line slopes. The 10 has come all the way back to the baseline here at the 6-month average. The 90 has still continued to curl up and is getting ready to leave the river again, and it can stay there for a good long while. And during this entire period, this was the last time that it went above zero, and it went from about 155 all the way up here to about 165. So, and then the bigger concern for me is the 30-period regression line is getting up towards a z-score of 2, and that's as high as it could get in the past 6 months, and so that's really been an extraordinary 30-day move, and a pullback here would not be surprising at all. And you can see how the jaws of the river have opened up. So a pullback to 164 would be right in the middle of that beginning leg up, and so that I would treat that as a tactical opportunity to buy strength on sale. Okay, so we're about 16 minutes into it. That's Ken Long from Tortoise Capital, and I'll see you in the chat room. Keep your risk measured and your powder